Recording in progress.
Hello everyone, good morning. Hello everyone, first of all let me introduce myself. My name is Wahidya Kriskiha and with NPM 2141190. I'm from Technocrat Indonesia University, specifically from Faculty of Economic and Business. The first one I have to or I will a presentation about financial ratio. What is financial ratio? Financial ratio are measures used to evaluate the financial performance of a company or business entity. Financial ratio describe the relationship between various items in financial statement, such as balance sheets and income statements, and help in analyzing certain aspects of a company's financial health. Financial ratios are used by business owners, investors, creditors, financial analysts, and company management to make important financial decisions. The sixth, this next one, the function of financial ratio. What is the function of financial ratio? Financial ratio are analytical tools used to assess the financial performance of a company or business entity. Financial ratio provide insight into various financial aspects of an entity such as liquidity, profitability, leverage, efficiency, and productivity. The main of function the financial ratio are as follows. The first one, evaluation of financial performance. Financial ratio help in evaluating the financial performance of a company over the period of time. They provide information on the extent to which the company has achieved its financial objective. The second one, decision making. Financial ratios can be used by company management, investors, creditors, and financial analysts to make better decisions. For example, investors can use ratio to assess whether a company's stock is worth buying, while management can use them to identify areas that require enforcement. The third one, we have identify problem and opportunities. Financial ratio can help identify potential problem in a company finance, such as poor liquidity and declining profit margins. They can also identify opportunities for improvement, such as increased operational efficiency. The next one, the fourth, is monitoring progress. Financial ratios are also used to monitor a company's development over time. By comparing the ratio from period to period, you can see whether the company's financial condition is improving, deteriorating, or remaining stable. The last one, comparison with competitors. Financial ratio allow comparison between a company and competitors in the same industry. This can be helpful in assessing the relative position of a company and identifying its strengths and weaknesses compared to competitors. Some examples of commonly used financial ratio include the profitability ratio, liquidity ratio, leverage ratio, and efficiency ratio. These financial ratio provide various insight into key aspects of a business entity financial performance. So, how to calculate financial ratio? Financial ratio are metrics used to measure the financial performance of a company or business entity. There are many financial ratios that can be used, and each provide different insights into certain aspect of a company's finance. Here are some commonly used financial ratio formulas. The first one, we have profitability ratio. In the profitability ratio, we have a four formula. The first one is gross profit margin. Gross profit margin equal gross revenue divided total revenue times 100%. The second one is net profit margin. Net profit margin equal net income divided total margin times 100%. And this with and the third one we have return on asset, ROA. ROA equal net income divided total assets times 100%. Return on equity, ROE equal net income divided shareholder equity times 100%. The second one, we have a liquidity ratio. In the liquidity ratio, we have current ratio and quick ratio. The formula of current ratio is current asset divided current debt. Quick ratio equal current asset minus inventories divided current debt. The third one, we have debt ratio. Debt ratio, we have two formula. The first one, total debt ratio equal total debt divided total assets times 100%. The second one, we have debt to equity ratio. Debt to equity ratio, long-term debt divided shareholders equity. The fourth one, we have activity ratio. Activity ratio, we have two, that is asset turnover equal total revenue divided total assets. And the second one, account receivable turnover equal credit income divided accounts receivable balance. The next one, we have inventory ratio. What is the formula for this inventory ratio? Inventory turnover, we have cost of goods sold divided inventory balance. And the last one, we have stock owner ratio. Earning per share or EPS. EPS equal net income minus preferred dividends divided number of common shares outstanding. These financial ratios are only a fraction of the many ratios available. It is important to understand that financial ratios should be assessed in the context appropriate to the industry and the specific company. Financial ratio helps stakeholders to measure financial performance, monitoring company development, and make better investment decisions. The next one, we have the methods of financial ratio analysis. The method of financial ratio analysis, time series analysis, common size analysis are tools used in financial analysis to understand the financial performance of a company. Here's a brief explanation of each method. The first one, we have financial ratio analysis. Financial ratio analysis involves comparing various numbers in a company financial statement to gain insight into the financial health and performance of the company. Some commonly used financial ratio include profit ratio, liquidity ratio, debt ratio, activity ratio, and others. Example of the financial ratio include net income to sales ratio, debt to equity ratio, and quick ratio. Financial ratio analysis help in evaluating a company's operational efficiency, finances, and solvency. The second one, we have time series analysis and forecasting. Time series analysis and forecasting are methods used to analyze financial data from different time periods and predict future trends. It involves the collection and analysis of historical data such as stocks price or company sales, and the use of statistical or mathematical technique to identify patterns or trends in the data. Forecasting can help in better decision making and financial planning. The last one we have common size analysis. Common size analysis is a method used to convert the financial statement of a company into a format that facilitates comparison. In common size analysis, each item in the financial statement is expressed as a percentage of total assets or revenue. Thus, comparisons between different companies or between different time periods become easier. Common size analysis help in identifying the main component in a company's financial structure and can be used to compare the company with its industry or competitors. These three methods are useful tools in evaluation of a company's financial performance and can be used together to provide a deeper understanding of financial situation and future prospects of a company. That's all for me. Thanks for watching and don't forget to subscribe for to know the next financial management. Thank you very much and see you next video.
Recording stopped.